All right, my friends, so I spent the last couple of days looking up the Vanguard Inflation Protected Securities Fund, VIPSX. And we're going to look at that today in context of the VFINX, the Vanguard S&P 500 fund. Just remember the VFINX, my understanding, is closed to new investors. So if you're like, well, I can't buy into that, I think the Admiral shares, and I don't know the ticker off the top of my head, the Admiral shares is the replacement of it. And the Admiral shares, I think, is like, I don't know, 3 basis points expensive or something like that. The drawback is the Admiral shares doesn't have the same track record as VFINX. So I'm always going to use that as my proxy simply because it goes back so long. It goes back to the mid-70s. Now, the Vanguard Inflation Protected Securities Fund only goes back to 2001, but that's still ample history behind us. The last decade was wonderful when it comes to analyzing just stocks, bonds, investment returns, because we had such a, just everything under the sun was combined into that one decade, and even going until now as well. I mean, it's amazing what happened. You know, a lot of people say from 1966 to 1982, the Dow didn't do anything, and that's incorrect. It did when dividends were reinvested. From price to price, it did not. And there's some good info there as well. Because you have basically a flat market with high inflation, you get a gauge of what a flat market with high inflation could look like from 66 to 82. But I'm just telling you, from the 2000 till today, you started with an incredible bear market, worse than 73 and 74. I'm trying to think, it wasn't worse than the Great Depression, but I mean we're probably talking about the worst bear market we had. Let's see, 9, 11, 22%, 73 and 74, 15 and 20. I mean, it's the worst decline since the Great Depression. No other way around that. So you have, and then of course, the previous 5 years, you had the greatest run in the history of mankind when it comes to capitalistic wealth. But we're going to put that aside because most people aren't concerned when they go to retirement about upside markets. They're more concerned about downside risk protection, risk mitigation, which is why the year 2004 is wonderful. Anyway, so you started with 3 straight years of pretty significant losses. Not just one fell swoop like we had in 1987 in October with basically 4 days. The market got hammered and then it came back just fine. Not just in 94 and 99 when you had a year that was kind of bleh. Or even 73 and 74. I mean, pretty big market declines in those years. But in this year, we had 2001 and 2, and going into March of 2003, significant, just painful market declines. And it's just, I mean, it wasn't a one-off. It happened time and time again. So we have a lot of history to look at there. And then it came back up nicely until, boom! The Great Recession of 2007 to going into March of 2009. And that was a big decline. That was a lot more painful, a lot more brutal than 2001 and 2 because it happened suddenly and it was forceful for sure. But then from then on, you had this nice run. So you have significant declines, decent returns, a big sell-off quickly, and then you had a nice run for the last 10 years. Now we're probably in the first of the, I think I just read the NASDAQ was in its bear market now, so finally the bear market is here as we see here today in 2018. We're just going to look it up till 2017. But anyway, the whole point about this is that we have just a lot of structure we can look at from 2000 until today, essentially. Again, this will be in 2017, to gauge what you could look at for your own investment ideas going forward as well. Because remember, no one cares about the upside. I mean, everyone wants the upside. People care about the down. It's risk protection that matters more. And again, Kahneman and Amos Tversky, I don't think Amos got the Nobel Prize. Maybe, I think Daniel Kahneman got it for identifying that people they like gains half as much as they hate losses. So if that makes sense. So a $100 loss is worth a $200 gain. Or I turn around, you need $200 of gain to get the equivalent of the pain of a $100 loss. Hope that makes sense. So that's Nobel Prize stuff there. These aren't even economists; they're psychologists from Israel who did these studies on people's hate of losses more than they love of gains. That's pretty interesting. So risk protection. All right, so let's go into this. This is gonna be messy, and I'm leaving this white space here because my next video I'm gonna add to it. We're gonna start with just the S&P 500. With reinvesting everything with no distributions coming out, none whatsoever, no RMDs, no distributions, whatever. And then we're going to look at Treasury inflated protection securities with the same thing. So we're going to compare these two guys. Now, at some point later, I will compare the Treasury inflated protected securities versus my favorite, Ginnie Mae, because I'm starting to wonder if Ginnie Mae is still my favorite, frankly. I'm not ready to do that yet, but I'll do that later on in another video. I got to get if you want to see what I'm talking about, here's all my spreadsheets that I got, just tons of data. It just goes on for sheets and sheets and sheets. Just tons of pages of various data, just using pretty simplistic calculate. I mean, you don't need to be a rocket science in this, my friends, or a software engineer. It's pretty simple to do once you get a gauge of what you're thinking about, but take some time to think. All right, so what we're going to do is we're going to start with $100,000, use the VFINX, and then we're going to actually, again, we're going to look at VIPSX against the Ginnie Mae, and then we're going to look at VFINX against the total stock index. And the reason for that is, and we're not doing that here yet, but just in future videos, VFINX is 70% of the total stock index. So just keep that in the back of your mind. The VTSMX is the entire domestic stock index, of which 70% is the S&P 500. So how much difference would it make to add 30% of small cap stocks and mid cap stocks to it? I don't know. We'll have to find out. On the other hand, how much difference would it make to have government bonds in the Ginnie Mae that's backed by mortgages as a way to deal with inflation protected? I mean, I don't know either of those. I mean, I will just see, but it'll be interesting. So we'll have branches off in here, looking at bonds versus looking at stocks. Probably won't get into international much as we go forward here. You can look at VASGX. I've done that on other episodes for that. But I just, Frank, at the end of the day, I'm not sold on international anymore. We'll talk about that later. At the end of the day, I don't know. All right, so we'll talk about that. So VFINX, $100,000, VIPSX, $100,000. We're just reinvesting the dividends. We're not doing anything, not taking money out. And as you can see, just because 2001 is when this guy came to fruition, the Vanguard Inflation Protected Securities, it's a bond fund. And so you can see the first couple of years, 2001 and 2002, the Vanguard or the Index 500. Oh, lastly, we're not directly investing in the S&P 500. You can't. You cannot do that. So you got to find an index fund with as low fees as possible that has a track record, because you can't invest in the S&P 500. So I just got to explain this. If you have the VFINX, you will guarantee underperform the S&P 500. It's guaranteed. If you have the Admiral shares, you're going to guarantee to underperform the S&P 500. Why? Because the S&P 500 returns 10. This guy returns 10 minus the insanely low fee. Let's say 0.10, 10 basis points. So you're going to get 10 in the S&P 500, which you can't do anyway. I'm going to get 9.9. I got to be that very clear, is that if you're looking at VFINX and you're comparing it to the S&P 500, it's silly because you can't invest in the S&P 500. You have to invest in a mutual fund or an ETF that mimics it. So just keep that in the back of your mind. All right. So 11.98, 22.27. It's going to be tough to read all this. I get that, but just, this is where you want to listen. So we started with $100,000. At the end of 2002, we were down to 68,418 in the S&P 500. And now we started getting back up, as you can see. So now at the end of 2007, we're back up to 124. But then we got hit with that insane bear market of 2008. So we're down to 78,369. Now, again, and I talked about this a video or 2 years ago, from October of 2007 until March 9th of 2009, this actually was even worse. I mean, this does not reflect that. The end of 2007 to the beginning of 2009, this was down about 55%. So you're probably sitting on, $65,000 at that point, which is painful. But anyway, so now we come back up. We're at 99,000. We got nice 27, 15%, a small gain in 2011, 15. 32, 13, a small gain in 2015, 12% in 2016, and 21% in Trump's first year. So when we started at 100, we went down from 100 to 88 to 68, and then we came back up, and then we went down again, and we haven't been down since. We're at 282,000 at the end of 2017. My inclinations could be a lot lower this year for sure, but it'll still be much ahead of where we were in the beginning of 2001. Now, let's look at what the VIPSX shows us. So again, this is a bond fund. And one of my guys, the guys talking about from the Army, he's the one who introduced me to this, just almost off just a throwaway line. He goes, "Hey, what do you think about this fund?" And I said, because frankly, I don't pay much mind to bond funds. I just don't. I don't know much about it. I like the Ginnie Mae has always been my default. I do not like the total bond index. The total bond index that Vanguard has is 70% of that is Treasury bonds. I'm thinking if you're doing the total bond index, well, heck, you might as well just be in the Ginnie Mae. And so I just don't like bond funds. Just don't get around that. Never have. I think I made that pretty clear in my 700 episodes I've done in this thing so far this year. I'm just not a fan. So, given that I don't like bond funds, I just never paid much mind to the inflation-protected Treasury fund that this guy was telling me about. And to my chagrin, because I look at it and I got to tell you, I'm a fan. No other way around that. Now, I haven't dived into it too deeply. Well, I'm not going to show you here. I will here in the next couple videos. VIPSX started in $100,000. So when the S&P 500 was down to 68,000. The inflation-protected bond fund was up to 125. We're talking, that's a $50,000 difference. No, more than $50,000. That's almost 65,000 difference there, my friends. And now we go 107, 125, 135, 146, 150, 151, 168. So at the end of 2007, the inflation-protected bond fund is at 168, whereas the S&P 500 is at 124. So we're still $30,000, $40,000 above. Now the next year, the S&P 500 fell to 78,000, and the inflated protected one fell to 163. But watch this: at the end of 2012, we are at 233, whereas the S&P 500 is at 135. We're 100,000 more at the end of 2012. Than the S&P 500 was, which is pretty amazing when you think about it. Now, we did get hit in 2013. We're down 8.92%, which is pretty significant, actually. And if I don't recall, what were the negative interest rate policy if the EU has been happening for quite some time? That might have been when they start kicking in. And so essentially there was no inflation. When you have negative interest rate policy, NIRP, N-I-R-P, that means inflation is they're trying to create inflation. There is not any. We didn't follow that here in the U.S., but the 10-year Treasury at that point, off the top of my head, I don't remember, but it was low. And I think it stayed low until 2015, as you can see here. So we went from 233 all the way down to 216, and by now the S&P 500 is catching up to us. So now we're at 226 in 2016, and the S&P 500 is at 231. And finally, we end 2017 at 232, where the S&P 500 is at 282. So the S&P 500 has captured 50,000 more than we did at the end of 2017, but it only in the last 2 years did it get that. I mean, literally in 2016 and 2017, you write those numbers off the table, and we're not. It's nuts. So that's 18 years, my friends, and the VIPSX, other than the last 2 years, was ahead of the S&P 500. That's reinvesting everything and not taking distributions out. So I'm going to do my second video now. Well, stay tuned. We're going to take this side of this, and again, this can be hard to see, but I'm going to keep this on there. My next video we're going to do with taking 5% a year off, and we're going to show you what it looks like after that. And then we're going to do a third video where we're going to combine the two to take 5% a year off if we combine the S&P 500 with the inflation-protected securities. I think you're going to like what you see, actually. I'm a big fan of this combination. It really has opened my eyes to something I hadn't seen before. And then we're going to look at looking at VFINX versus VTSMX, again, just adding the 30% exposure to small and mid caps, and then we're going to look at VIPSX to the Ginnie Mae, just again comparing the two bond funds, because I'm curious. And if I'm curious, you might be as well. You might not be, but if you do like what you see here, stay tuned. Subscribe down below. You can always go on heritagewealthplanning.com. If you want to donate to old Josh, by all means, you'll see that little PayPal thing up there on. You'll see where it says Amazon, books, Facebook, LinkedIn lead, and it'll say PayPal. You want to throw a couple bucks my way, I'd be happy to take your money. So don't hesitate to do that as well. And we'll see you next time. Thanks, guys.